The United States operates a $29 trillion economy, but in 1776, this was a collection of 13 colonies with empty pockets, attempting to finance a revolution against the world's most powerful empire. The founders faced the primary hurdle of all economics: scarcity. Resources are finite, but the need for them is not. In the early days of the war, the Continental Congress had an army to supply and no gold to pay for it. They turned to fiat money, using a printing press to create the Continental Dollar. This paper carried no gold backing. It was essentially a government IOU distributed to soldiers and merchants to keep the war effort moving. Without underlying assets, the currency's value dropped 99% in 5 years. The new nation learned its first lesson. A currency only works if the people using it believe it has value. Wealth is built on trust. Alexander Hamilton proposed a high-stakes solution to this lack of trust. He argued that the federal government should take over $25 million in war debts held by the individual states, centralizing the nation's liabilities. To manage this debt, he established the First Bank of the United States. This institution provided a stable money supply and a way for the government to pay its bills. Seeing a predictable system, foreign investors began buying American bonds for the first time. Hamilton weaponized the debt to create credibility. By building these institutions, he set the rules that allowed American markets to grow. This is the business cycle. Capital floods new industries, triggering rapid growth, then retreating in an inevitable crash. In the 19th century, without safety nets, these cycles were violent. Panics in 1819 and 1873 left banks in ruins and cities filled with the suddenly unemployed. The cycle reached a breaking point in 1929. A stock market crash wiped out $30 billion in value within a week. As banks failed, millions of people lost their life savings, and the financial system seized up. This triggered a collapse in aggregate demand. When 1 in 4 people lost their jobs, they stopped buying goods. Without customers, more factories closed, creating a spiral that the private market could not stop on its own. The New Deal altered the government's role in the cycle. By funding massive infrastructure projects, the state provided jobs and income directly to citizens, stepping in as the employer of last resort. The Great Depression demonstrated that a collapsing private market requires state-driven spending to restart. This period established the state's budget as the primary tool used to catch the economy when the business cycle fails. The post-war expansion ended with the 1973 oil shock. An embargo quadrupled energy prices, creating a massive supply shock hitting every corner of the economy. This produced stagflation, a scenario where unemployment and inflation climbed together. High energy costs pushed prices up, while the slowing economy pushed jobs out, leaving the country trapped between rising costs and falling wages. To break the cycle, Federal Reserve Chair Paul Volcker used monetary policy. He raised interest rates to 20%, making it expensive to borrow money. This move restricted the money supply and forced the economy to cool down. Volcker's high rates triggered a deep recession, but successfully drained the inflation out of the system. It showed that the government could use the money supply to deliberately contract the economy when it overheats. In the 2000s, the crashes became faster. When the housing bubble burst and Lehman Brothers failed in 2008, the global banking system came within days of a total meltdown. 12 years later, the economy halted entirely. The 2020 pandemic caused the fastest job loss in history, with over 20 million people becoming unemployed in a single month. The government responded with quantitative easing and multi-trillion-dollar stimulus packages. By injecting massive amounts of cash into the system, the central bank and Congress revived demand almost instantly. Modern policy no longer waits for the market to self-correct. However, these massive interventions carry a long-term cost, often resulting in periods of high inflation. The current expansion is fueled by capital investment in artificial intelligence. Companies are spending hundreds of billions on data centers and advanced chips to build out this new infrastructure. This technological surge is driving productivity to its highest levels in decades, mirroring the growth patterns of the railroad and early internet eras. Yet this wealth is shadowed by a national debt approaching $37 trillion. For the first time since World War II, the amount the government owes has climbed above 120% of everything the country produces. This tension remains at the core of economics. It is a negotiation between the drive for growth, the reality of scarcity, and the unpredictable nature of human panic. After 250 years, the American economy has shown a relentless capacity to use catastrophic failure to trigger its own reinvention. It evolves not by avoiding crises, but by using them to force a more resilient version of itself into existence.